And good afternoon, ladies and gents, and welcome to another insightful webinar brought to you by Standard Bank Online Share Trading. My name is Palesa Moyaba, and I am with the Standard Bank Online Share Trading team. And today we bring you our China economist, Jeremy Stevens, as he gives us his insightful views on the current landscape of the Chinese economy. As you'd all recall, not so long ago, the China Communist Party hosted its third plenum and announced some measures on how to potentially stimulate the Chinese economy. So there's a lot happening in that part of the world. Without further ado, I would like to hand over to my colleague, Jeremy, who has been following these developments very, very closely. Thank you very much. Jeremy, over to you.
Yeah, great. Thank you for the introduction. Can you hear me just as a starting point?
Absolutely, you're audible. I can hear you.
Awesome. Cool. Okay.
Fantastic.
Okay, yeah. So obviously to the clients who tried to dial in a couple of weeks ago, let me just extend my apologies for the technical troubles that we had. Luckily, I guess all of you will know that not much has happened in China in the past few weeks. And so I'll just run through some super old slides that don't really cover any of the new stuff. I'm sure you'll all be totally fine with that. But no, obviously I'm following what's happening, and I've got a refreshed pack for you guys. Let me just share my screen. Okay, so I'm assuming that at some point all of you will be able to see this. And so you can see the title, Can Equity Prices Dislocate from the Real Economy? I have just an hour, so I'll be as crisp as possible, and I'll try be as opinionated as possible, just so that you get more value. At least you'll know exactly what I think about stuff. Whether I'm right or wrong is less important at this point. There's obviously a lot to go through because, as you'll all be very, very aware, there have been some significant movements from the policy front. Obviously, most powerfully from the monetary authorities just before the October holiday that we got back from holiday yesterday. And then this morning, certainly not in terms of fiscal policy, but obviously equity markets have moved in a dramatic way over the last couple of weeks. And I think navigating this frenzy demands at best cool heads. So I'll walk through what I think are the most important aspects. Just as a reminder for context, what we're actually dealing with here is a Chinese economy that's undergoing significant structural changes. And so people need to bear this in mind when they try and interpret what's happening in China. It's utterly foolish to try and, for example, ring fence the domestic policy priorities of the leadership here from, for example, trade relationships between China and Africa as a proxy for China's rebalancing. So this slide is basically just trying to capture a couple of themes that are important context for the cyclical stuff that I'll talk about, which is one, you can see from the first image there, the green line. Very clearly, China's imports from Africa have grown at a much slower pace over the last 5 to 10 years than they had the 5 to 10 years before that. So much so that the presidents of China's promise to triple imports from Africa between 2021 and 2024 were abysmally not met. And it just speaks to the reality that China's demand for the stuff that we tend to export is sort of not reaching a top, but it's certainly growing significantly slower than it had before. The second image there, you can see quite clearly from, in terms of growth between 2021 and July 2024, this is obviously at these countries' exports to China. You can see that China's, for example, transition to the green economy and sort of moving towards a low carbon economy has really impacted China's imports from the DRC, for example. They're growing at about 44% over that period year on year. The third image there, the trade concentration story, I'm just trying to bring to people's attention that many African countries, and particularly those ones circled, are incredibly reliant on demand from China, including the DRC, but also Angola, for example, its oil exports, also South Sudan's oil exports. And you can see on the left-hand side where I've got degree of trade concentration, that's really trying to measure just how reliant these countries are on just one or two exports. And so what we're seeing is a growing reliance on China and Chinese demand, but at the same time, we're seeing a Chinese economy that is rebalancing away from those traditional engines of China-Africa relations. And then finally, this final sort of image here is just giving you context to, it's about a third of Africa's exports to China go from South Africa. And we have by far the most diverse export basket. And you can see, so these forces that are playing out in the China-Africa relationship are playing out quite clearly in the China-South Africa dynamics. So things like chrome, manganese exports are growing relatively robust rates. As they're consistent with China's sort of transition to green energy transition. But at the same time, our iron ore exports and other base metals have been growing relatively slowly. And the importance of this is that this is what we're actually talking about as it relates to China's economy. We can talk about the cyclical stuff, but this is the proof that China's economy is undergoing a fundamental transformation that needs to be the context in which we understand some of the cyclical dynamics playing out. And giving sort of additional life to those arguments is that these sets of slides basically try and reflect a story that I've been telling clients for the best part of the past decade, which is that China's development model has indeed run out of road. Its policy tools are more blunt than they've ever been before. The positive multipliers for the traditional policy levers are more muted than they've been in the past, and the space for them to roll out additional fiscal and monetary policy support at aggressive scale, at least as a proportion of the GDP, is more limited. We know that the dynamics that have played out post the global financial crisis, and even as a result of the COVID pandemic, have exacerbated some of the structural imbalances inside the Chinese economy. And therefore, it's injected a kind of level of instability into the party, which subsequently sets off a gradual sequence of events and changes since the start of at least 2016. I think there was quite a fundamental juncture in the policy space post 2015. Which manifested most recently in the adjustment in the relationship between real estate and the economy, which is still ongoing. We're 3 years in on that policy. We're also seeing much slower lending growth. You can see on the bottom right-hand side, very clearly bank lending has fallen dramatically. We're also seeing much weaker local government spending as they get more conservative and more focused on indebtedness. And it, to my mind, explains to some extent why the Chinese authorities have tried as best they can not to roll out what would be a traditional credit-led stimulus since 2016. And that's through the trade war, that's through the pandemic, and that's even now, even though the economy is relatively weak. And they're trying to do as little as possible, basically, to prevent momentum loss from exacerbating the sentiment. They obviously don't want the economy to underperform dramatically, so they're doing what they can to prevent that from happening. And at the same time, at the moment specifically, they're trying to boost sentiment as best they can. And this has been the story for the past 5 or 6 years at least. And it's still the context for what we're seeing today. So just because there's been an additional commentary and meetings around from the Politburo and so on, as we'll get into, it doesn't fundamentally change the reality that China's in the structural transformation that's going to be ongoing for a number of years. And finally, another set of variables that you should think about when it relates to the China macro environment and this sort of frenzy around fear of losing out and missing out on the financial side is that the policy uncertainty around China, you can see on the bottom right-hand image there, has been widening and elevated since this 2015, 2016 period, where China for many, many decades was a sort of bastion for stability, particularly for emerging markets. It is no longer the case that there's sort of a one direction when it comes to the Chinese economy. And policy uncertainty is relatively elevated, and that has manifested in higher credit default swaps, a sort of equity market that has been sort of bouncing around pretty low levels, but quite volatile, and also a currency that's been under pressure in different waves over the past couple of years. So that is the context. Now we turn to this sort of party that we've had over the last 2 weeks, which was basically triggered after the National Bureau of Statistics released credit data on the Friday. The monetary policy authorities basically, we're going to have an emergency meeting on Tuesday with the national financial regulator and the securities regulator. And at the time, that was kind of an explainer around what was relatively weak credit data. And as I say, they were going to meet on Tuesday. They met on Tuesday, and obviously we know what happened on Tuesday. There was a cut to the main policy rates. There was a cut to the RRR ratio. The PBOC announced new lending facilities to support the A-share market. There was an auxiliary commitment to recapitalize the 6 largest banks. And there was, which we knew was going to happen, was a reduction in existing mortgage rates. And somewhat less well-known was a relaxing of the funding criteria for affordable housing projects for SOEs. And since then, the Shanghai Composite Index has jumped 21% in a couple of days, rising to the highest level in over a year. And clearly, I've been inundated by clients wanting to know as much as possible around what does this mean for the Chinese economy. So what's been interpreted by the financial media as a stimulus to supercharge growth should really be seen as a relief package. And I think this is very important to stress. Nothing in the detail that has been released by the Monetary Authority, or for what it's worth, the NDRC this morning, creates much additional economic activity. It's unlikely to get, at scale at least, firms investing in household spending. And instead, at least how I interpret what's happened on the monetary policy side, as far as I can tell, is that this is preparatory work, getting the financial system ready to accommodate what is likely to be a fiscal expansion. And that fiscal expansion is almost definitely going to include a large chunk of central government and local government bonds. Hopefully more central government bonds, but in reality, it's going to be bond issuance. And the big buyers of the bonds when they get issued are the financial institutions. So on that, I think that what is interesting is how urgent the policymakers have seemingly been. For months and months and months, there's been a steady stream of influential policymakers, think tanks, academics, and so on in the domestic landscape that have been, one, acknowledging the economy is not where they had hoped it would be or where it wanted to be or where they thought it would be. And secondly, that there needs to be much more fiscal impulse coming from the authorities, and preferably in the guise of those mechanisms that can support domestic demand. This sudden pivot that we saw last 2 weeks ago now, because of the holiday, could be a light bulb moment that's cascaded down from the very top. And I don't want to be like all conspiracy theory about all of this, but it's also worth recognizing that, you know, it was the 75th anniversary of the founding of the People's Republic of China. And historically, no one's really mentioned this that I've seen, but historically, in big events, the party doesn't like negative news. It doesn't like sentiment to be depressed. It doesn't like stock markets to be falling. And so it could just also be that they wanted to do something before the party celebrations. The point is that it does seem like there has been a significant policy pivot from the top. How durable, how sustainable, the jury's still out on that. But certainly they did a hell of a lot of work led by Pan Gongsheng on Tuesday and subsequently last Thursday. So specifically, it's quite impressive how Pan Gongsheng, the PBOC governor, who was obviously told to come up with a package of support measures, was able to do so in quite a comprehensive manner, which suggests to me that this has been prepared and this has been in the pipeline for a while. It will certainly help that the triple R ratio was cut for the banks by 50 basis points, because that's the cheapest source of funding for banks. Furthermore, in what's an unusual move, he also gave forward guidance around the triple R, saying that it will come down again in Q4. So a very clear picture coming from the central bank around we're focused on ensuring liquidity of the financial system. Now, historically, and I just want to for you to bear this in mind, is that historically, say, from 2010 to 2017 or 18, a triple R cut was almost definitely seen as directly stimulatory, because it was going to result in a positive credit impulse. However, nowadays, at least over the last 18 months, a triple R ratio cut has traditionally been, because credit demand is so stubbornly low, the cuts have traditionally been paired with a surge in local government financing of bonds, or at least local government bond issuance. So I interpret these triple R cuts as, again, confirmation that this isn't stimulatory on its own, but it's likely to result in bond issuance coming down the line. Another smart inclusion was the commitment to recapitalize the big banks. What we know is that the smaller banks who are more reliant on some wholesale funding, or they can't get borrowing from directly from the PBOC, and so they tend to rely on lending from other financial institutions. Those banks are more exposed to some of the pressures on the local government side, some of the pressures on the misallocation of capital and credit resulting from real estate developments and wealth management projects and so on. And so a lot of those smaller banks have been the focus of the regulators for many years. Over the past 4 years, each year, about 200 billion in bond issuance has gone to recapitalize the small banks. And now it looks like it's time for the big banks. You can see from that bottom left-hand table that in terms of the sort of traditional metrics that you would look at for regulatory macro prudence, most of the metrics are pretty robust, which suggests that the banks themselves would say they don't actually need the capital. But it seems to me, reading between the lines and reading from what the PBOC has been saying since at least February of this year, is that they don't really buy these numbers. And as I say, they've been raising alarm about the slow progress of NPL disposals for a number of months now. And the fact is that they seem to at least think that this sort of relatively low NPL ratios, despite what's happening in the real estate sector, despite what's happening to local government balance sheets, despite nominal GDP growth slipping below 4%, they obviously think that, flat or declining NPL ratios is highly unlikely. And so I think that the regulators believe that banks have been prioritizing capital at the expense of asset quality. And so they've been maximizing profits by avoiding the recognition or writing down of bad loans. And I think that the regulators believe that profit growth has slowed to such an extent that this game can't carry on anymore. And so the central bank is getting on the front foot and committing to recapitalize some of the larger banks. And right now, estimates are for about 1 trillion renminbi in bonds to be issued to recapitalize the banks as a starting salvo. And I think that ballpark's probably relatively accurate. Now, one of the things that I've been telling clients for a number of months now is that the PBOC, because obviously there was an expectation that as soon as the Fed cuts, they're going to cut aggressively. And there was a lot of head scratching around why they hadn't been cutting more aggressively during the course of this year. And my belief is that the central bank has been quite reluctant to cut interest rates. They did so a month ago, and now they've obviously done it again. But I say reluctant because I think that the central bank and the people who I've spoken to at the central bank, including the head of research at the bank and at the securities regulator, all share my view, which is hardly controversial, that the weakness in the demand for credit is not because the price of credit's too high. The reality is that credit growth is low because economic activity is relatively low and there isn't a demand for credit. And so cutting interest rates is highly unlikely to result in a surge in bank lending, which you can see from the top left-hand image. The blue line is growing at the lowest levels basically on record. And that's despite the fact that you can see in the second graph that even before what happened 2 weeks ago now, monetary policy is actually the most accommodative it's been since 2011. And it's also worth recognizing that despite loan growth being so low, at 8% at the moment, it's still growing significantly faster than nominal GDP growth, so twice the speed of nominal GDP growth. It's growing 3 percentage points faster than demand deposit growth. And so obviously it's making it increasingly difficult for banks to meet their risk-adjusted capital regulatory requirements, or, as I've mentioned already, dispose of NPLs. And policymakers know that rate cuts, unless you cut deposit rates, which push depositors away from the banks even more, the fact of the matter is it's going to continue to erode net interest margins of the banks, which are currently at 1.5%, the lowest they've been in almost 20 years. And this has actually been the fundamental headwind for the monetary authority to cut rates, which they've been talking about since the start of this year. And in fact, at the press conference on Tuesday, Pan Gongsheng specifically said the reason why he's comfortable now of cutting rates is because he believes that the monetary policy framework that they've been building for the past couple of months, which is more focused on setting a single policy rate that then cascades to the rest of the lending and borrowing rates, is now functioning relatively well. And so as a result, he thinks that this move will leave bank profitability neutral. Obviously, time will tell if that's true, but already we have seen the medium-term lending facility, which is the cost of one-year money, come down 30 basis points. We know that the loan prime rate, which is going to reset at the end of this month, will reset at about 25 basis points lower. Deposit rates will probably fall soon. And so maybe he has a point that lending rates will all come down together, and so will borrowing rates. But my view fundamentally is that the Politburo instructed, or the State Council instructed, the monetary authorities to move in preparation for what will be a fiscal impulse. And this package of measures have been in place or in the pipeline for a while. They pulled the trigger on these things in a very coordinated, sophisticated way. But really, the central bank is much more focused on ensuring liquidity in money markets and to keep rates steady in light of what they expect will be increasing government bond issuance. So now we go to today, which is the appalling, I would argue, intervention by the NDRC, the macro planner. So everybody, I mean, this was actually live streamed by a lot of the financial media, this press conference, which usually an NDRC press conference, nobody's caring about at all. Because the reality is that everybody's waiting to see what comes on the fiscal side. Its impact will basically be determined by how much and how it's structured and where it goes. And for what it's worth, over the past 2 years, November, we've seen a additional rollout of local government bond issuance or special treasury bond issuance last year to the tune of about 1 trillion renminbi, largely because the economy has been needing additional support. And so we did expect by October there would be some announcements around additional spending support, because even last year, and I had to sort of look back at the news flow last year and the data last year, sort of October time, November time, and at that time, China's economy was actually beating economic forecasts. Sequential data was improving. largely because of base effects. We also saw that the consumption growth story was improving and the composition of GDP growth was actually relatively healthy. This time around, it's no surprise that there is additional support coming, but it's obviously come much sooner than most had expected. And importantly, the Politburo meeting on the Thursday that discussed the economy. Traditionally, the Politburo meets 3 times a year, April, July, and October. And that's the time where they discuss the economy. They obviously meet every month, but the other meetings are to discuss other topics. This time around, clearly they prioritized the economy, which is a massive signal. Now, traditionally, these statements that come out of these meetings are relatively light on detail, and this was the case again. The policymakers basically said something like they need to have a strong sense of responsibility in economic work, which most people interpret as there needs to be more urgency. They called for more proactive measures. They said that they would focus on implementing existing policies, but then they also stressed that they need new policies, or they were going to introduce new policies. They went on to say, and this was the part that most in the financial media and myself included latched onto, which is they said they need more increase the intensity of monetary and fiscal policy. And because it was coming 2 days after what had happened from the PBOC side, the assumption was that this means that there's going to be an as large pivot from the fiscal side. And again, that clearly meant the issuing of more government bonds. The problem now after this NDRC meeting is that we still need to guess, because unlike the financial regulator and the PBOC regulator, this macro planner meeting that was scheduled amazingly offered almost no clarity, nothing new. They mentioned that they will timely research new policies. The low point was the chairman, Zheng Shangjie. He said that China will front load 100 billion renminbi from 2025 central budget for construction projects. But the reality is 100 billion is like not even a drop in the ocean. It got to the point where the CCTV, the national sort of TV broadcaster, asked a question at the end of the press conference saying, do you have anything specific to announce? And the answer was more generalities. They said that they even went as far as to say that they're going to implement the third plenum's decisions. I mean, it was so either someone's going to get fired, like someone seriously is going to get fired because the markets did not like this meeting at all, or this is a deliberate intervention to pull back expectations because, like I say, markets had rallied dramatically, and in the domestic media, there are some think tanks and analysts and professors talking about there needs to be a sort of 10 trillion renminbi stimulus package from the fiscal side coming from central government bonds. They're saying that the fiscal stimulus in 2008 was 10% of GDP. That would be 13 trillion renminbi this time around. So, they're talking about, 30, 50-year ultra long-term bonds won't be a problem when they need to be repaid, blah, 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 blah. So either someone's in trouble because this was a mistake, or this was a deliberate intervention from the policymakers. I suspect that that the central government, despite what it tells the world to buoy expectations, is still going to stick to patiently advancing their structural reform agenda. And I believe that this is not going to benefit wealthy upper middle class families in tier 1 and tier 2 cities. This is about the tier 2 and 3 cities and tier 4 cities. It still seems reasonable as far as I can tell. I think it was Reuters or Bloomberg that reported that they're expecting 2 trillion in renminbi bond issuance by the end of the year. I think that ballpark sounds realistic. It's not even that high. Last year, they did 1.5 for debt swap, and they did another trillion for special treasury bonds for disaster relief. 2 trillion is hardly dramatic, and certainly wouldn't sort of fundamentally move the dial for the economy, but the rumor is it's 2 trillion. One's going to go to boosting domestic consumption. Specifically, 500 billion of that's going to go to bolster the trade-in program. This, as I've said many times before, the trade-in program is hardly awe-inspiring. It's hardly really moved the dial in terms of big ticket items, which it's focused on. And really, and I've said this to you many times, the reality is it's just cannibalizing other types of expenditure, because it's not dealing with expectations and insecurity around jobs and future incomes and so on and so on. But there was some reporting around families with second kids might get a 800 renminbi subsidy. That's about 10% of the homes. There's other direct transfers that are being spoken about for particularly poor households. And I think that circle of savings as a share of disposable income is really what they're trying to tap into. I mean, there's a recognition that, if you compare the balance sheets of Chinese households to US households, the big difference is really that they save a big share of their disposable income, and tapping into that would make sense at some point. And so they're trying to do what they can at the margins to support that and help that. The other half of the bonds, importantly, are planned to go towards paying down some of the local government indebtedness. Last year, as I say, they did 1.5 trillion of swaps. They haven't done any this year. And what's happened is a lot of the special purpose bonds that are supposed to be allocated towards funding infrastructure projects, those have, I think it's 44% of them have gone to pay down existing debt. And at the same time, so obviously that's problematic. But secondly, there's this wave of austerity that's been washing through the local authorities, and that's had quite big ripple effects on their employees. Obviously, there's been lots of stories about cutting salaries, cutting back on non-wage income streams. There's also been a lot of discussions around local governments not paying their suppliers, which is cascading into their cash flows and their sentiments and their ability to pay wages. And so the idea is that if they can sort of remove part of the beast, which is the threat of local government indebtedness, that might diminish the pressure on local authorities to embark on what is a wave of fiscal austerity at the local level. And it might have a sort of concomitant ability to kind of support business sentiment for the SMEs and also for households. However, fundamentally, my guess, and I think it's been justified by what we saw from the NDRC, is my guess is that policymakers will continue to be incremental. They will continue to aim to do as little as possible because they know that a lot of these things that they have to do aren't necessarily in the long-term interests. Some of them will be designed like using the central government balance sheet to absorb some of local government debt. I think that they will say, things like, we're going to carve out the COVID-related debt because that was sort of unplanned debt that the local authorities had to take on, and so they'll issue bonds to refinance that and put that on the central government's balance sheet, for example. They're not going to go out crazy and do sort of blanket rescues for the local authorities. They've been pretty clear about that. And I think, like I say, they'll be incremental because they will want to wait and see the impact of these mechanisms and interventions in terms of boosting sentiments and changing the nature of the conversation at the local level to see if they can create a positive multiplier and ripple effect. Finally, I think it's worth mentioning, and it all cascades to this, is that the reality is that China is a very different economy to what it was 15 years ago, 10 years ago, because of the impulses and assertiveness that China's had in terms of ring fencing GDP growth from cyclical momentum over the past 15 years. The reality is that its fiscal resources have become increasingly stretched. And when you overlay that with the reality that the fiscal authorities and their revenue collection mechanisms have been built around an investment-led growth model that is fading, what we see is that the tax and non-tax revenue as a share of GDP has actually been falling for the best part of the past decade. And that's just reflects this reality that the economy is a different economy. And even as it rebalances, the fact of the matter is it doesn't really generate significant revenue from consumption, from income tax, and so on. And so there needs to be quite a fundamental rejig in the tax revenue base. And the mechanisms through which to do that at this point would dent consumer confidence and business sentiment. For example, a property tax would fundamentally hurt the real estate sector even more. Taxing income at a higher rate would obviously again impact consumer sentiment. And so a lot of the things that they would like to do, they actually can't do at this moment because of sentiment. And then for local governments, the pressure on them to restructure their revenue streams is incredibly significant, as land sales revenues are never going to get back to where they were in the past. And what we know is that, and even the NDRC in their meeting today did say that a lot of the local governments have resorted to penalizing and retrospectively investigating firms in their localities to try and roll out fines and to generate revenue. In the first half of the year, general budget fiscal revenue was down year on year, but non-tax revenue was up about 12%. Now, part of that is some of the provinces, particularly these 12 in the orange at the bottom, have been selling some of their assets. But at the same time, it also speaks to some distortions that are probably coming from rolling out fines on people in their jurisdiction. And the regulators are watching that very closely because they recognize that that is another way in which what's happening here is going to continue to hurt local authorities and local sentiment. But like I say, all of this tells me that the Beijing will have to, at some point, continue to assume a larger and larger share of local government debt repayment obligations. They'll have to absorb greater responsibilities for social services and things like that. As the economy, as the society ages and more people retire and so on, as they release hukou reform and they let people move, suddenly there's going to be significant amounts of people arriving in tier 1 and tier 2 cities needing access to social services, access to education facilities, and a lot of those pressures are going to have to be absorbed by the local authorities over time. Now, that then sort of finally leads me to what's happened to the financial markets. This was sent to me by a friend, which I then redrew myself. But you can see that what we have seen, it's the green line. The stock market has absolutely surged, at least until today. And I think that's because of how the stimulus has been designed. Obviously, it's largely making the case that stock markets will get whatever support they need. And I do see this as utterly separate to the things that I've spoken around before. As I mentioned, the PBOC created 2 new facilities. One is a swap line, which basically financial institutions and brokers can swap A shares for government bonds and then use those bonds as collateral to borrow more, to buy more shares. And then they created a relending facility where PBOC will lend to the banks at 1.5%. The banks can then on-lend that money at 2.5% to firms, and those firms can then use those monies to involve themselves in share buybacks. Markets clearly love what had happened. Now, the reality is it's quite a big pivot from what the financial regulator has been doing since he took over in February. Wu Xing has been predominantly focused in trying to rebuild trust in the stock market and to try build the credibility of the institutions that manage and service the stock markets. So, for example, making sure that public disclosures are accurate, making sure that the accounting and the credit ratings are accurate, but also obviously focusing on corporate governance and things like that. And the idea was to create a much more realistic, reliable financial market that is no less seen as a casino than it was beforehand. Clearly, this move fundamentally throws that mechanism and that program out of the window. The question is why? Why now, and why the stock market? And I think, as far as I can tell, this is also about boosting sentiment. I think that there's a hope that households will be able to generate and offset some of their declining wealth from the housing market by participating in the stock market. I also think that they think that the economic sentiment and business sentiment will be boosted by an elevated stock market. And like I said, it seems to be working. Markets opened massively this morning until the NDRC had their stock market meeting. There's apparently been incredible demand for retail investors to open new private individual equity accounts. A friend of mine, again, the same friend, in fact, sent me a photo of it's a stock market sort of webinar, a seminar for teaching people how to trade the stock market. And the photo was very, very scary because literally everyone seemed to be gray-haired. They seem to be 65 to 75 years old. It seemed to really reek of people taking advantage of naivety. But the reality is that people are greedy. Financial players are very, very greedy. The rich are greedy. That's how they've probably made money in the past. And we know that the very wealthy people in China, the ones that have accounted for the vast majority of the surge in household savings deposits over the past 3 years, have been sitting on their money. They've sold assets because of asset disclosure issues in recent years. Then when they would have traveled and bought luxury apartments overseas, they haven't been able to do so. And, since the last 2 or 3 years, they've also been incredibly cautious around overly showing their wealth. And so we've seen them sit on money, but these guys are definitely going to make sure that they don't miss out on this stock market boom. And so this mobilization of funding has really triggered quite a significant move. And I would just make the case that, I don't care if stock markets rally, to be honest. It's not really my job to care. I care about the economy. And like I've said, nothing that happens in the stock market in China has anything to do with economic fundamentals or cash flows. And to that point, I would just say that this is an incredibly dangerous move if you're inflating a stock market bubble by design, by policy dictate, without creating mechanisms that will boost earnings. This just sounds like this could seriously end in tears. And just for what it's worth, I've been here before many times. The stock market has done crazy stuff, 2015 being a good example, where the market had a huge boom-bust cycle. I can tell you the last 2 securities regulators have both been fired because they couldn't manage the stock market bubble. And so this is just dangerous stuff that the Chinese authorities have been engaged in. I will touch on the data, but this will be very quick because it's already 1:45. All that's worth saying is, why are the policymakers reacting potentially now? You can see nominal GDP growth is actually at 3.97%, which is the lowest in many, many, many years, with the exception of the pandemic. Sequential GDP growth is slow. My metric for sort of where we are in terms of economic activity in July was 4.4%. It's now sort of round about 4.3%. That's real growth for what it's worth. They've been battling deflation for over 5 quarters. The macroeconomic data has been losing momentum for the best part of the last few months, at least the high frequency ones. Granted, in August, only 5 lost momentum. So there's been some reasonable stabilization between July and August. But the reality is that the engine of economic activity that we've seen operating since the pandemic, with the exception of the base effects coming from consumption last year, has been supply, supply, supply. And the production side of the economy, just by virtue of the fact that it's impossible that it continues to grow at the speeds that it's been growing for the past while. Has to slow. We've seen industrial value add come off considerably, down from 6.7 all the way to 4.5%. We see manufacturing investment, the blue line in the second image there, also starting to slow. Very, very scarily, the red line is infrastructure investment, which in August came in at 1.8%, which is, I think, an important trigger for the policymakers, because they realize what's happening at the local government level is not sustainable. It's not like they want, 5-6% growth in infrastructure investment, but clearly they can't end the year with negative infrastructure investment. And so that's part of the reason why some of this policy has been designed. It's also natural that the advanced manufacturing story is starting to slow, and we're seeing that numbers are also confirming that you need a new engine for economic activity. Granted, the last data point was a slight improvement. It came in at 49.8, I think, from 49.2 the month before, around about those numbers. Services came in at 50, though, which is the lowest, I think, since December of 2022. So clearly, the engine of the economy, whilst I'm not saying this is collapsing, what I am saying is that it just can't continue to maintain the momentum, and it needs another driver of economic activity. And what we've seen this year is that it's highly unlikely to come from the consumer side. The only real point here is that consumption came in, I think June was 2.1%, then it recovered to 2.7% in July. In August, it was back down to 2%. Those are like very, very, very uncomfortable numbers for the authorities. Sorry, 2.1% in August, it says there on the slide. Those are incredibly low numbers. I mean, we knew that retail sales, for example, would slow because of the base effects from last year. We thought it would go from like 8.5% to 4%, 4.5%, but right now it looks more like it's going to be 3% for the year, which is significantly lower than they would have hoped. And the big problem is, and it's in that third image there, the blue line are actually showing you that the base effects coming from the tail end of last year are not that supportive. And so you could see those numbers actually perform worse than the market expects. And the red line in the final image is showing you pretty comprehensively that this sort of push in the big ticket items is just not working. And the reality is, like I've said, it's, you're subsidizing the consumption of one thing probably at the expense of another thing, because people's wallets or the size of their income streams aren't changing. And so they're cutting back on spending elsewhere. And that's exactly what this slide is trying to repeat. Again, I'll be fast, I promise you guys. Sorry for wasting your time, but this first image here shows you very clearly that the third red line is absolutely obliterated consumer sentiment. So COVID wasn't the cause of this sharp collapse in consumer sentiment, which I mean, when you look at the graph without those labels, you assume that's a COVID thing. But COVID, actually, they recovered from COVID pretty soon after the pandemic. It collapsed. Then there was a zero COVID end. There was a slight bump. But since the start of this year, the numbers actually deteriorated, and we're sitting at levels that have never been seen in terms of consumer sentiment. You can see nominal disposable income growing slower than nominal GDP growth, which is shocking given how low nominal GDP growth. You can see that this image is on the bottom left is the youth unemployment data stream. Some of you will know that sort of mid last year, they stopped publishing the youth unemployment without any explanation. And then I think it was around about February of this year, they released a new index that excluded some people from the some subsectors of the youth from the number, and it came in. So as you can see, it was up at like 20% and people were talking about it a lot. Then it disappeared. It came back at, I think, 13.9 or 14 point something percent, fell down, and now it's quickly rising up towards 20%. And obviously what happens when that hits 25%? I mean, that's so, and the reality is, if you're a university graduate and you're expecting to get this really sort of cool high paid job in the high tech sector or whatever it may be, and suddenly there are no jobs, plus you have to stay at home, you don't get an income, your parents have to save more to sort of offset that. Their sentiment is obviously depressed. So this is a pretty scary, ugly picture for the party. And then the final image there, you can see quite clearly what this has meant is that it's meant that households have saved and they haven't been keen to spend on big ticket items. No surprise there, despite the subsidies. That's only February data, but I would argue that this has just continued over the recent time. Then on the real estate sector, we do think that this is 3 years in and it's just going to continue. We know that the weaker provinces are the provinces that have the highest inventory levels. They're also the provinces that have the weaker economic fundamentals. That's been proxied by fiscal deficit as a share of GDP. They're also the most indebted provinces. So all of these problems are sort of overlaying themselves on the local government's balance sheets. And the weaker you are, the more vulnerable you are. And the bigger problem for the real estate sector is this ugly, hideous maroon, sort of burgundy, pinky colored bar graph, which is telling you that 80% of the construction that's happened since 2018 has been in tier 3 and 4 cities, which are the cities that are more vulnerable and weaker. So the excess supply, the excess stock is sitting on these regions, and they're not coming back anytime soon. Finally, exports. I say finally, I mean, I could go on forever. I'll stop after exports. But exports, what they've been doing is really cutting costs. You can see unit prices collapsing, the red line in the image. We also know that they've benefited from a weaker currency. They've wiped out basically 10 years of currency appreciation against their trade-weighted basket in about a year and a half, a year. That's made their exports more price competitive. And at the same time, they're pivoting towards developing economies. And you can see quite clearly that the faster growing economies have been developing economies. So the traditional sort of larger economies in the yellow there, you can see quite clearly have been growing slower than the emerging markets. My computer's running out of batteries. I'm just moving. Hopefully you can still hear me. So just end there. There's 5 more minutes, and I think there's probably some questions. I'm really hoping that my laptop still has battery in 5 seconds. And hopefully we can go to a dialogue.
Fantastic. Thank you very much, Jeremy, for that insightful webinar. It's safe to say that you're good at economics, not so much the drawing part. I'll just move over to the questions quickly. We do have a few questions. One from Andrew Ford, who's our regulars, and he's asking if the Chinese central bank attend the Jackson Hole when other central bankers actually meet.
Yeah, they absolutely do. So is the question, do they attend Jackson Hole with the
other central bankers?
They attend. Yeah, they're very well represented in all global institutions, whether it's those kinds of forums or ECB forums. I mean, they're actually very assertive, very present, and you know they're doing a couple of things. So one is they're trying to elevate their voice in existing institutions of the Bretton Woods system, but then at the same time they're trying to sort of build out their own institutions in which they have an agenda setting ability. And so yeah, they're present, they're engaged.
Okay, fantastic. Thank you for that. And there's just another question that is coming from Andrew, and he's asking, how big is the foreign investors in the Chinese market?
So it's small, but I mean, they've been underweight, aggressively underweight, basically since November of last year after the third plenum. The reaction to sort of the doubling down on sort of Leninist maxims of monopoly of power, and you know the party says jump and you say how high, and you know this doubling down on the party can sort of dictate terms to the market and to institutions inside the society, really did fundamentally spook some of the investors. At the same time, China's undergoing economic slowdown and greater economic uncertainty. And so there's been a dramatic pull out from foreign investors in terms of the Chinese equity market. But certainly in the last couple of days, we've seen a massive re-engagement of the hedge fund community in terms of building their exposures back. And they've gone from underweight to neutral at this point, as far as I can tell. And I do know, like places like Goldman's and those sort of influential investment banks are saying that 15-20% gains from the equity market from China is likely. And so there's certainly a huge appetite suddenly re-emerging from the developing investor base.
Fantastic. Shane, I've unmuted you. You can certainly ask your question.
Hi, Jeremy. Thank you for the presentation. So my question relates to the underwhelming fiscal presentation today. And, given that credibility is so important to the Chinese and that they did something very assertive with monetary policy, to subsequently do something that was underwhelming stroke incompetent with fiscal policy, they seem policies that are very much at odds with each other. And so you say that you're unsure about whether it was intentionally underwhelming or accidentally underwhelming. I mean, what tea leaves can we watch for here? And I mean, because of the nature of the way people are employed, you'd think a response could be quite swift. And I mean, you mentioned also that Goldman Sachs, for example, have upgraded China to overweight. I mean, surely that's good news for the CCP, and they don't want to kind of undo all of that kind of hard work in getting Goldman's and people like that to that point, just to have everything fall flat.
Yeah, I think, Shane, you're totally right. And I'm good to see you and hear from you. Look, they do have a tendency so everything you say, I agree with, and I'm absolutely shocked at what happened this morning. I'm staggered, speechless, uncertain as to how to interpret it. The tea leaves are, is someone going to get fired? I think that would signal that clearly someone made a big mistake. I think you're totally right. The party really wanted the good PR, and I saw the domestic media, friends of mine on WeChat, just going nuts about how amazing China is and they're the best performing stock market of the year and blah, blah, blah. So, you see this roll out and it's in real time and it is happening for real. I think that if it's a mistake, someone will lose their job for sure, and it will be reasonably high profile. You'll see them get punished, just like we've seen the securities regulator. So the ex-chairman of ICBC became the chairman of the securities regulator, and he was very unceremoniously dumped. Subsequently, the next one who replaced him was fired, and that was all pretty crystal clear that was for those mistakes. So if someone gets fired, we'll know that was a mistake. But I do also believe that the authorities don't like massive changes in the narrative, and they don't like massive buildups of positions in either direction, particularly around the currency. We've seen that over and over again. When there's a big buildup of shorts or longs, they want to diffuse that. So maybe they just didn't like the degree to which expectations had ratcheted up, and maybe they wanted to pare that back to some extent. Because, like I say, the financial regulator and the PBOC last night were warning financial institutions not to mess around with the stock market and not to make sure that the credit policies are going to the places where they're supposed to go, and not to embark in financial shenanigans. So, is it them trying to pull the tone back to some extent? I'm not sure, but this was abysmal. I mean, this was really, really bad. And you saw stock markets basically get smacked as a result. And now, because what I was saying a week ago or a week and a half ago is like, the good thing about this is that they've done all of these things at once. So they haven't done like a piece that helps the affordable housing and then a piece a few weeks later. They've done it all at once to try to get as much bang for their buck in terms of sentiment. And I thought that was a smart play. Now to just derail it in one, firstly, I would still be long Chinese equities. I think that there's a commitment to ensuring that this liquidity works and that if needs to, they can extend and roll and add to this. So I think that you would be foolish to think that this is not going to work out. I think this is going to rally for some time. Where I take umbrage is predominantly on commodity prices. I think there's absolutely no reason why commodity prices should rally as a result of this, because I don't think that it's stimulatory in a way that will support those levers of growth. And then I do think potentially it's dangerous to stoke an asset price bubble if they're so detached from economic fundamentals. Because if anything, the stock market's been seen as something that hasn't been reflecting economic fundamentals for the past 30 years, where you've had the best performing economy in the world for 30 years and stock markets basically moving sideways. Now you've got the reverse of it, where you've potentially got stock markets rallying, but they've got nothing to do with economic fundamentals. So structurally and sustainably, this isn't great, but I would still be long stock prices.
And a quick follow-up, I mean, you mentioned the very large numbers of retail stockbroker accounts that have been opened in the last 10 days, to the extent that people stayed over the holidays to process the new accounts. Do you think that the CCP is in favor of this development, or they are, or not?
No way. No way. I hope not, and I would guess not. And I think that as stories like this come out, there'll be a sort of regulatory blowback. But I don't think that necessarily derails the stock market rally, because I don't think that the stock market rally is meant to be fueled by sort of the average Joe on the street. Yes, to some extent, higher equity prices, like I said, does offset some of the wealth loss. Long term, they want more and more people to be involved in the stock market. But I do recall that the big trigger in 2015 was the average Joe on the street that was invested in the stock market and margin trading. That was causing them to really worry about what will happen when there's a correction. My guess is that this is high net worth and big financial firms that are aggressively rolling into these positions, and they'll stay as long as they think that has legs, but eventually it will probably be palmed off to the retail investors over time. But because anyone with a brain is going, well, I want exposure to that, and there's a whole big industry of security brokerage firms that are seeing this as an opportunity to build out their client franchise. They're abusing this, and I think that they will fall into the trap of getting crushed by the regulators at some point. That would be my guess.
And Myron, I've unmuted you. You can ask your question. Thanks, Shane.
How's it, Jeremy? How are you?
Hey, I'm cool, Myron. How are you?
Fine, thank you.
Whatever you're going to ask me, you know the answer to better than me, but you're happy to ask me.
No, I'm just not at all, right? I'm just pointing out, maybe it wasn't a one-way bet, as maybe, the previous caller said, because there were enough information out there that suggested this wasn't a one-way bet, right? Firstly, there was an article, for what it's worth, in the Wall Street Journal that suggested, and from quite a well-connected journalist,
Ling Ling,
right? And she suggested that, even the party was concerned about the expectations running ahead, right? And who knows if it was true or not, right? And then last week, Xi Jinping himself, in the 75th party celebration, one event, came out to say, it looks like the economy is still in trouble. And, it wasn't like he suggested that this bazooka is coming out in any form or whatsoever, right? And lastly, even the invite from the NDRC said, and I'm not sure if somebody's going to get fired, because the invite from the NDRC specifically said this is incremental policies are going to be announced, right? I think this was, it could be, I don't know, right? I could be wrong, who knows? Maybe some thoughts, man. Thanks.
No. Myron, it's a great sort of anchor, right? Because I also followed some of those things that you've mentioned, and I think that they are important. And when I saw Ling basically say, hey, I'm hearing from sources that they're not loving this over-egged expectations around fiscal policy and this meeting tomorrow, which was today. I thought, okay, as you say, she is connected. She knows what she's talking about, and maybe they are. I mean, but at the same time, I saw the Ministry of Finance's ex-head of research, who's an old grey-haired dude, talking at Tsinghua University, saying, he thinks that 10-15 trillion in stimulus is not off the table. So, I seem to think that, look, right now they're doing less than they did last year. So that seems to be a misalignment with at least what happened in the monetary policy and the Politburo. Now that I can't fully understand. I mean, literally, it's less than last year. So something has to happen, whether it's 2 trillion, 2.5 trillion. If they absorb 1 trillion of the local government debt and refinance it and put it on the central government balance sheet, that's not really such a big deal when you're looking at 65 trillion renminbi of indebtedness. So basically, my view from the very beginning has been this isn't going to move the dial cyclically from an economy point of view. But I still believe that the stock market rally, like I said to my wife yesterday, I said, if we've got money, can we put it in the stock market? And she said, how's my copper call from 2 years ago going? And I said, not very good. And she said, well, then probably not. And I mean, she's cynical because she's in the domestic media and she understands that this is a lot of massaging of sentiment. But if I had 1 million renminbi, I would happily put it in the stock market today, but I'd want to probably pull it out in a month. But none of this, like the title of the presentation says, the question is, can stock markets dislocate from economic fundamentals? Because they're going to have to, if it's going to be a rally.
Maybe just to follow on, if you look at past financial hiccups, that's the right way to say it. You needed bank to be recapitalized to, double-digit percentage of GDP, right? Even China's history in the past, in 1998 and so on, GFC, all these big bubbles, and we've had a bubble in China, a bubble of many things, not just one thing. So, what would I have to see to say, look, they're finally cleaning up their act, they're recapitalizing the banks, and it's not like it's unprecedented for them to recapitalize the banks to 15% of GDP. They've done it before. Korea's done it in the Asian financial crisis. That was 28% of GDP. 1 trillion is not even 1% of GDP, right? It's not big enough. What do you think?
I know it's nothing. It's nothing. It's totally nothing. I mean, they lend 1 trillion a month in bank lending. It's nothing. But I think that if the regulators get their way, you'll start to see more recognition of NPLs and more sort of acceleration in asset disposals. And that would probably signal to me that they're starting to clean up the bank's balance sheets. And with that, they might need to sort of incrementally add capital to the banking sector gradually. But the first step is for them to stop lying about NPL ratios. Until they do that, then everything's a lie, and then it doesn't really matter whether it's 2 trillion or 10 trillion. That would be my belief. And if you look at the monetary policy reports from the last few quarters, that's kind of been where they've been focusing. They want asset disposals from the banks to accelerate, and they want to do what they need to do to accommodate that. So I would say that would be where I would at least look at whether or not they're serious around cleaning up their act. And then as a result of that, the size of the recap will probably be determined by the size of what they're willing to recognize as MPLs.
And last question, and I'll leave you alone after that. What do you think is the potential growth with or without recapitalizing the banks in China? Are we talking 2%? Come.
No. So I still think so if my maths is right, I still think 4% is possible if they are able to finance the renewable energy transition and they decide to front load the 30 years in 10, which seems to be what they're trying to do. I still think that because the estimates are that that's somewhere between $22 trillion and $30 trillion they need to invest by 2060 to hit their targets. Now, if they do what they've done in property, which is front load generations of supply and deliver it in 10 years, it looks to me that that's what they're trying to achieve in green energy. What that doesn't mean, Myron, is it doesn't mean that the financial system doesn't have new potential locus of MPLs, and it doesn't mean that they get a grip on debt to GDP, right? So it means that possibly debt to GDP goes from 300 to 380. And then in 10 years' time, you're sitting with, you've had 4% growth for that decade, but at what's the cost, right? Like where's your vulnerability now, and where is your threshold for rupture? So I do think that and I think that that's what they're trying to do. I think that they aren't necessarily trying to clean up the economy. They're trying to make sure that the resources are allocated to the parts of the economy that they prefer, and they're trying to facilitate that. And they're trying to make sure that those parts of the economy that are hurting their longer term objectives are resolved. And that's local government debt, that's bank asset growth, that's bank potential financial risks, that's certainly risks in the smaller financial system. So they're trying to sort of manage that transition. And that's why they're being piecemeal and incremental in their policy impulse. Because if they were really desperate to see GDP growth, they would do a bazooka. And they would fundamentally change expectations around where China's heading. But I think that next year, the growth target will be 4.5%. The next year will be 4%. The next year will be 3.8% or 4%. And they'll be fine with that as long as they can transition the economy. And remember, they've got peak. So the average age of blue collar workers in China is 55 years. So they've got 10 more years of labor supply before those people retire, where they think that they've still got access to a pool of labor that they can use to build more stuff. So it's building less old stuff, less roads, less ports, less bridges, but it's building more renewable energy, more transition, more storage, and those things. And then the question is that big enough to offset slowdown elsewhere for them to net off at a reasonable growth rate on investments? And what does it mean for consumption? And does consumption grow at 2, 3, 4% for the next couple of years? And is that 2 percentage points of growth or 1.5 percentage point? Who knows? But I think that 4% is still doable, at least for next year.
And maybe just the very last one, do you think the government understands what the problems are, number one, and they have the data to understand the problems what they have? I mean, from my point of view, sitting outside, it looks like they definitely got a handle of what's wrong and what needs to be done and what they're willing to do. But, and the data, because we sit on the outside, we don't have access to the kind of data they have, right? And the kind of intelligence that's there in the system, they know what the problem is. That's an important point, right?
Yeah. So it's, you can say that they don't have, like, the National Bureau of Statistics isn't necessarily publishing secret data that they've got access to, but they certainly have access to real-time data from Tencent. I mean, I'm not trying to create conspiracy theory and like Tencent now, like, I'm just generally speaking, I would guess that they have access to real-time data from big Chinese companies that are operating across multiple jurisdictions, local governments. They know what the banks are doing. They know what bank appetite is for credit by sector. They know all that stuff. They have to. So I think that they know what the problems are. And I think what Xi Jinping has done is he's basically said, we're going this route, and I've got the wherewithal and balls to see it through. And that's kind of like what he's developed over the past 10 years. Now, people might disagree with it, and that's fine, but he doesn't care. So where it's interesting is kind of what Shane's spoken about as well, which is like how they try and manage sentiment and expectations. But the reality is, since 2015, they've done less fiscal stimulus than the markets wanted year after year after year. And economic activity is underwhelmed year after year after year. And they seem to lie about how much they care about that, how much they're willing to do to support that. Time and time again, it's like, we're going to stimulate, we're going to do more, we're going to support consumption, we're going to support private sector business sentiment, but nothing really happens. Right? They seem to be doing the bare minimum. So I think that that's still the case. And by doing the bare minimum, I think it's reflecting the fact that they know that they need to do the bare minimum to continue to address what are the challenges going forward, to put them in a better position to potentially achieve what are their primary objectives. And I do think fundamentally they are pivoting towards this common prosperity and looking after low-income families and poorer families and elderly, and they're trying to do what they can to that end, but they're trying to go as slowly and gradually as possible, which is true to what they've always been, which is slow and gradual.
Awesome. Thank you so much, dude. Very helpful.
Yeah, no. And okay, so for any last
Sure.
point is I'm there at the end of October, and if you have a need to see me or chat to me, please feel free to reach out to me directly or to Tim Clark. I'm sure many of you know Tim. If you don't, then Palesa can probably forward the information on to you.
Ladies and gents, thank you very much for your time today. I know we are way over time than our usual 1 hour, but I think this engagement has been rather very valuable. Thanks again, Jeremy, for making the time. I know it's probably very late for you. And yeah,
no, it's all right. It's no problem.
Yeah, thank you very much for your time. For the guys that we didn't get the chance to answer your questions, I will send them on. I'll consolidate them, send them on to Jeremy,
Perfect.
and respond to you directly. And just a reminder that none of the information shared on this webinar is actually advice, and the session can be made available as it was recorded. Thank you. Have a good day. Cheers.